Okay, let's finish up talking about risk and return. And again, the next observation or the next thing that we want to look at is something referred to as excess returns. This is the average rate of return of the security or of the investment minus the rate of return on the average rate of return for treasury bills. So if you look at the bottom of your CT bills, the excess return is zero because it's that return minus that return. The excess returns for stocks, you can see that small stocks average around 15% more return than what treasury bills get. They also have, again, this is over 12 times, 13 times, around 13 times more risk than treasury bills. So again, you get 15% more return, but you also get a huge increase in risk. Likewise, with the S&P 500, again, the average excess returns 8%, and for that, it costs you roughly 19.8% in risk. So again, it's roughly what, 6 times riskier, and you get 8% more in return. So again, what can we do with this information? And again, the general idea here is that we are just referencing and referring rates of return to levels of risk. So what does that look like graphically? If you take those securities we had from that first graph, you can see that they all sort of line up on a nice little line here, right? We won't talk about what that line might be right now, but again, what you can see is as we go up the direction here to the upper right here, we can see that we're getting to higher and higher volatility. Standard deviation is increasing, and the rate of return is also increasing. So higher returns are typically associated with higher risk levels. So is there a positive relationship between volatility and returns? Well, we're going to look at another slide here in a second, and really the answer to this is there's no real precise relationship between volatility and return. Larger stocks tend to have lower volatility. All stocks tend to have higher risk and lower returns than larger portfolios. So let's look at this picture to see what we can gather from it. So this is a graph of the S&P 500, and it looks at the individual components. So the yellow triangles here are stocks, the top 50. The diamond is 51 through 400, and the circle is 400 to 500. Now, it's not really super easy to see here. Let me see if I can make this just a wee little bit bigger. This might help us see things a little bit better. Here we go. That's a little bit better. So here are the diamonds or the triangles. And if you look at them, those are the triangles. They're all mostly in that area. So where are the triangles? Well, if you notice, there's some over here, but the bulk of the diamonds, they're right in here. Where are the circles? Again, if you look at the circles, where are those circles? I need another color here. Sorry about that. We need let's use this color. And if you look at the circles, again, the circles are in this area, right? So as you move across, if you're moving in this direction, what you're seeing is what? Increasing risk of stocks. Now, the risk that we're looking at here is volatility, but the thing that we're trying to show here is the small stock influence. that even in the S&P 500, smaller stocks tend to have higher risk and higher returns than the other stocks that are in the S&P 500. So again, we basically see that risk is related to returns, but it's not a precise measurement, or at least, let me go back. Volatility and standard deviation are sort of related to returns, but not directly. We need some more work to help us with that. So let's continue on with this. So now that we're looking at risk, we want to understand the parts of risk or the components. So common risk is risk that's perfectly correlated. Let me go back here. I want to change my color back. I don't like that green. So let's go back here. We'll use red for a while. So common risk is sometimes referred to as market risk, right? Market risk is perfectly correlated. Everything is related, right? They affect all stocks. So common risk and market risk. Sometimes this is referred to as systematic risk. This risk is related to all stocks. No matter what you do, you can't get rid of it because it's in everything. Independent risk, though, sometimes refer to this as firm-specific risk. It only affects individual companies. It's uncorrelated, which means that when you combine things, the lower the correlation, the less contribution for each into the overall risk spectrum. So you can get rid of some risk if you combine things that are uncorrelated. So diversification is the process of averaging out the independent risks in portfolios. So in other words, to diversify a portfolio, we need to combine assets together that have uncorrelated components or parts. So what does this mean? When many stocks are combined in a large portfolio, the firm-specific risk is gone. It's averaged out, if you will. Now, this doesn't mean that it's not still there. It's still there because you haven't done anything to the company. What we haven't done is we have not, we have combined them together. They're still there, but they're interacting with each other, if you will. So the systematic risk, though, that's the part that's left over, is still going to affect all the firms. So that systematic risk, or the common risk as they refer to it, cannot be diversified away. So you'll see here we have some, I'm calling them morals of the story, if you will. So the risk premium for a diversifiable risk is zero. So investors are not compensated for holding firm-specific risk. So what this means is that what do you get paid for assuming or taking on a portfolio that has diversifiable risk? And the answer to that is you do not get paid. So the rate of returns that you see are related to the common risk, not the diversifiable risk. So if you buy a stock, a great example is P&G. P&G, by all stretch of the imagination, is a pretty darn good company. They have decent returns over time. But what if your one and only investment is P&G stock? Right? you're going to get the rate of return of P&G stock. That makes sense, obviously, I hope, right? But what about the risks that you're taking? The returns that you're receiving are not compensating you for all the risk that you're taking. Now, it's not that that's a bad return, right? The return is good, but you have to understand that you're not getting paid for some of that volatility, right? So again, the idea here is that as an investor, you can get rid of this firm-specific risk for free just by spreading your investments out, right? You need more than one investment, right? So that's the general idea here with the risk premium, is that you don't get paid for that. So next, the risk premium of a security then is determined by its systematic risk, and again, does not depend on its diversifiable risk. So standard deviation then is not an appropriate measure of risk for an individual stock. Okay, so there is a distinction between volatility and market risk. So we need to be able to come up with a statistic or some metric that can help us measure the market risk, because it is the market risk, that common risk we talked about, it is the market risk that determines the rate of return on the investment. So to measure the systematic risk of a stock, we need to determine how much variability of the return is due to the systematic risk, right? So we need to determine how sensitive a stock is to systematic risk. We want to look at the average change in returns for each percentage change in return of a portfolio that fluctuates solely due to systematic risk. Well, what does that mean in English? In English, it means we're going to compare stocks to a large stock market metric, S&P 500, for instance. We want to measure that relationship. Since it's so big, the S&P 500 would be considered as being a portfolio that has zero diversifiable risk. It is completely market risk oriented kinds of returns. So if we compare the two, we have a measure of sensitivity. So now we're not measuring volatility, we're measuring variability. So before we move on, let's have a couple of definitions. An efficient portfolio is a portfolio that contains only systematic risk. So there's no way to reduce the volatility of that portfolio, right? You can't get less risk from an efficient portfolio without lowering its expected return, because the return is directly related to the systematic risk, and in this portfolio there is only systematic risk. So the market portfolio is an efficient portfolio that contains all the shares and securities in the market. In fact, theoretically, the market portfolio contains all the investments in the world. Now, we obviously can't measure that. So what we typically use is something like the S&P 500 as a proxy for this market portfolio. I would say that you could use something called the Wilshire 5000, very big market. One of the indexes that you do not want to use, not that you do not want to use, but it's just not used in research, right? People researching market activities is the Dow Jones Industrial Average. Again, it only has 30 stocks in. It's not quite as efficient, right? It may contain some diversifiable risk, where the S&P 500, we assume it does not. So what do we get then? There is a statistic that's called beta, and beta looks at the expected percent change in excess returns for a security for a 1% change in the excess returns of the market portfolio. So again, beta is different from volatility. Volatility measures total risk, while beta measures only systematic risk. So if you want to understand the riskiness of investment opportunities, since you're building portfolios, beta is what we use for a portfolio. Standard deviation is a measure of risk if you're just looking at an individual asset. So let's look at this. So here's just a handful of stocks. These are on the lower end. Here's the betas of these companies. And if you look, these are all companies that you probably have heard about, at least most of them. McDonald's has a 0.63 beta. Hershey is 0.33, right? Tyson Foods, 0.19. So all this is telling us is what? That these betas are low, right? They're on the lower end. What about individual stocks? Here we have, again, going up the scale. Now we have some what? Higher beta stocks. These stocks have more variability, not volatility necessarily, more variability. Now we go up above 1.0. Now we're getting to stocks that are pretty risky stocks, right? So all of these stocks have betas, again, greater than 1, and they're reaching pretty high. So how do we interpret these numbers? So again, a security's beta is how sensitive its underlying revenues and cash flows are to the general economic conditions. It relates them to the stock market. So stocks in cyclical industries are going to be more sensitive and have higher betas than stocks that are in less sensitive industries. You would expect car manufacturers, which is a relatively stable market, to have lower betas than anything in the technology world that is just filled with variability. So a beta that's equal to 1, we say that it has average risk. It is average risk, or the same risk that's in the stock market. If the beta is less than 1, it has less than average risk. Greater than 1 means it has higher than average risk. So again, if you look up a stock, you can find its beta, and from that, what can we tell if you're just looking at beta? All you can tell is whether or not it has higher or lower than average risk than stocks in the stock market. So again, how do we measure and how do we incorporate this into returns? So the market risk premium is the expected return on the market minus the risk-free rate. So this essentially, the market risk premium, is a measure of an excess return. If the risk-free rate is the treasury bill and the expected return on the market is the S&P 500, then the market risk premium is that excess return. And if you remember earlier, we had a slide, a table that had the excess return of the S&P 500 was, I believe, 8.6%. So if you can only invest in two things, this is the return you would get. If you invested in the S&P 500, you would get this. If you only invested in treasury bills, you'd get this. It's the difference or the excess returns. So how can we incorporate this into returns? So we have a formula here. The expected return is the risk-free interest rate plus the risk premium. So that is the risk-free rate. Now here's the market premium, but the risk premium incorporates also the riskiness of the asset, right? So here's the market premium. Here is the risk premium. So again, if this number is 8, I'm going to use 8 to round off the number. Then if this number is 8, if the beta was 2, 2 times 8 is 16. Add that to the risk-free rate, you end up with the rate of return on the investment. So again, this is what we typically refer to as the security market line. It comes from a theory called the capital asset pricing model. And again, the purpose of this model is to help us, number one, understand the relationship between risk and return. As you note, it is a straight line relationship. In addition, it comes from this capital asset pricing model, which is the theory that we assume relates or illustrates this relationship between risk and return. Helps us to calculate returns that we might expect if we buy a stock. It helps us understanding the cost of capital. What does it cost a company to issue common stock or to use equity funding? This is a picture or a formula that tells us what this return of a stock should be. And again, we'll talk about this as we go through other videos. The relationship between risk and return is in everything. It is probably the most important relationship that we have with respect to stocks. So that is the end of this video. I look forward to talking to you in the next one.